focus on running the business. At the end of the day, the industry will come back. There will still be transactions. Dentistry is still such a young industry in terms of consolidation and M&A and private equity that it's inevitable that the market will return. Will it return with the same gusto as we saw in 2021? Maybe, maybe not. I doubt it, but it will come back to some degree.
All right. So very, very excited today for our guests. But before we get there, we've got to go to our Ask Ken segment. And the question that came in this time was from an unidentified listener, and they were asking specifically, what is the fastest way to figure out if you're going to run out of cash or not? And I love that question. It's something all of us should be afraid of, that if we're not monitoring our cash properly, we may not have enough to make payroll, or we may not have enough to take care of other priorities. With that being the case, the very best thing you can do is build out what's called a 13-week cash flow forecast. And this is where you are forecasting out, looking forward and seeing what is going to happen to your cash flow over the next month, 2 months, 3 months. And by doing that, that gives you a really, really good opportunity to see what's going to happen with cash, how much is payroll going to be, and you can line all those things up together. So thank you for our anonymous tipster on that one. And now I'm really excited to welcome Gareth Petsch to our episode today. And this is one of the very first founding episodes of the Dental Truth Project. So grateful to everybody here, and Gareth, especially grateful to have you with us.
Thanks, Ken. I'm happy to be here.
All right. Well, as you know, Gareth, the mantra for this podcast is about pulling back the covers, finding out what's working and what's not working inside of the dental industry. You and I are both non-clinicians, so we're not going to go down any clinical road per se, but there are certainly a lot of things that you and I wish were a little bit different in the industry. And so I wanted to just go ahead, give you a minute to just give a brief background so our listeners know who you are, and then we're going to jump right into that truth that you feel like needs to be exposed.
Yeah, happy to. By way of brief background, I've been in healthcare services for just over 20 years in various different parts of my career. Coming out of the banking world, most notably in my 25-year banking career, I created Citibank's industry vertical that focused on healthcare services in 2011 and ran that through 2023. There, we supported an enormous amount of dental roll-ups from an M&A perspective, and we're helping a lot of institutional capital providers buy and roll up DSOs, and I was lucky enough to be a part of the DSO boom. I since then have transitioned out of corporate America into a small boutique healthcare investment banking firm based in Austin called PH Partners. And here we help clients like DSOs get access to the capital markets, be it through equity or debt, as well as through M&A transactions, be it selling minority or majority of their DSOs and other MSOs, not just dentistry. So we do deal with other parts of healthcare like primary care and pain management and surgery centers and all sorts of other stuff. I'd say about half of what we do is dental. And mainly what I'm working on is lower middle market and middle market healthcare companies. So my clients hire me to sell themselves, sell a portion of themselves, or help them buy someone else, or just as simple as raising capital for them as they think about their next level of growth.
Awesome. So tell us now, as you're thinking about this, some things in the dental industry that you'd love to see be different or you think could be improved upon. Tell us what you're thinking about there and how would you attack it?
Yeah. As you mentioned earlier, we're not clinicians, right? So I think we're going to avoid all of those issues, of which there are plentiful, and many clinicians will have many other different opinions here. But coming out of the lens that I see, which is on the capital market side, dentistry is in a little bit of a challenging timeline in the sense of where the investor pool, and I use the word investor loosely, right? I think investor as in equity, as in buyer, as in debt placement. Anyone really writing a check has really leaned outward away from dental specifically. And I say it's also physician practice management in general, right? Coming out of COVID, I think a lot of the investor class realized that, hey, the higher cost of a care provider and the high cost of an MD or a doctor and the shrinking EBITDA margins, we don't have as much control over that as we once thought we did. And so as a result, the investors have sort of taken a step back or hit the pause button on investing into physician practice management. And that, of course, includes DSOs. And so I think we've seen in the dental space a lot more volatility in the M&A, as well as valuation challenges. And the deals that have gone through the process in the past sort of 18 to 24 months, the expectations remain pre-COVID levels in terms of valuations versus where the investor class is actually spending dollars. And sometimes that gap is quite meaningful, and it's caused a lot of failed transactions to occur over the past several years. I think if you had asked me the similar question in 2021 and 2022, which arguably were of recent history, the high point of DSO transaction volume, for every one transaction coming onto the market that may have had a few bruises and bumps, regardless of that, there were multiple bidders for that transaction, causing a bidding war in a sense to push those multiples up to, in hindsight, what may have been historic numbers. In today's environment, for every transaction that's coming into the market, there are multiple other competing sellers that have cleaner or better looking accounts and better looking financials. And so the number of tire kickers this year or the last 18 months have been significantly higher than they have in previous years. And so as a result, the multiples have started coming down, and the transactions that are getting done are supreme, ultra clean deals. And those with slight sets of bruises and bumps, they're having a harder time getting across the finish line. In addition to that, I think you've also seen the gap widen between lower middle market, smaller companies versus the very large DSOs. I say large is, I'll call it 50 million for argument's sake, 50 million of EBITDA and up. You haven't seen many of those transactions going through really any of the market. And so those folks have by and large done recaps using equity or have gone through debt transactions to restructure their facilities and get them prepared to continue to grow. And they've been consolidating the consolidators, right? So that trend is still going on. But as a result of that, those large groups haven't transacted, meaning that they haven't been able to see the multiples that they wished they had seen or that they've modeled themselves out to be. But they have created an interesting effect on smaller companies, call it sub 10 of EBITDA, maybe even the 5-ish million of EBITDA companies. They're still transacting. They've, some cases seen some benefit as a result of those folks not being able to transact, right? Because they've have to gone out and grow using acquisitions of $4, $5, $6 million acquisition DSOs. And so look, I think if I was to summarize, I'm hoping that with the impending noise around rate cuts, although it's not going to be the straw that breaks the back of the camel in a sense that there's going to be a flood of transactions when rates start to get cut, but there's usually some consumer confidence that follows a rate cut. And I'm hopeful that it will stem some of the transaction volume that has been holding off for the past several years to start to feel confident enough to do deals. Now, I do say, though, having said that, I think physician practice management will lag behind the market from a consumer confidence perspective. And then to a further extent, dental will lag behind. So I'm hopeful to see dental start to turn around earlier than 2026, but we'll see.
So yeah, could you just touch on what do you think is causing the lag on the physician based and even dental specific?
Yeah, certainly. So investors, when they look at transactions, they look at margins and they look at how they can return their capital to their LPs over a predictable period of time. And certain things have to occur in order to do that, right? They buy low and sell high and grow the companies rapidly throughout that journey. Coming out of COVID, I think investors realize that when you're paying very high salaries to MDs and hygienists, and your fixed costs really don't change much. And then when you factor in things like interest rate hikes, right, your cost of capital goes up, your weighted average cost of capital goes up. You look at staffing costs coming out of COVID, escalated dramatically. There was also a significant amount of hard costs like supplies, vendor materials, things that maybe you haven't necessarily budgeted for an increase went up. And so margin compression was a major concern as you come out of most DSOs, and most physician practice managements have had margin compression. And typically, say if you're in a burrito making business or a restaurant business, if your costs go up, the normal course of business is to pass those cost increases to your customers. And unfortunately, for physician practice management and DSOs, it's not that simple. You can't just tell a customer, hey, the cost of materials have gone up, your crown just went up 15%, because Delta Dental and the other insurers will have a hard time with that, right?
It's the lack of being able to control the pricing, where that's been, so to speak, delegated to the insurance company, that can hurt and compress margins because you just can't move the revenue up at the same pace to cover the cost increases. Is that a fair way to say it?
Exactly. It will eventually catch up, but it's a several year lag for the insurance companies before they're going to increase their reimbursement rates. And so who has to absorb that? And that is the corporations, the dentists, the folks who are providing care for the most part. And so as a result of the margin compression, investors have said, look, we have all this money sitting on the sidelines. We'll still look at dental deals, we'll still look at PPMs, but we're really going to reserve our dollars for the premium companies. And we're okay paying a little more for the premium company. In the meantime, we're going to go ahead and invest in other sectors of healthcare that might have less of an issue, and maybe the margin compression has been within control a little, more so. Say, for example, like med spa, you look at behavioral health, you look at ABA therapy, healthcare IT, AI, lots of other places where these folks can invest and use those dollars while the physician practice management industry sort of straightens itself out. So we've seen a lot more interest in sort of practice adjacent companies, supporting service companies, tech companies, and RCM and those types of investments happening more so than physician groups in the past couple of years.
So what would be the primary advice you'd give a group that's sort of, let's say, stuck, meaning they know if they get into a process with a private equity group, they're going to probably just the look, but they most likely are more excited at the moment about other industries and other verticals than dental. So what would be your recommendation to an operator that's trying to figure out what to do next, besides sit on my hands and wait for the tide to turn?
Yeah, I think the short answer is it's going to depend on every one individual's DSO's circumstances. I would say that aside, focus on running the business. At the end of the day, the industry will come back. There will still be transactions. Dentistry is still such a young industry in terms of consolidation and M&A and private equity that it's inevitable that the market will return. Will it return with the same gusto as we saw in 2021? Maybe, maybe not. I doubt it, but it will come back to some degree. And I think the fundamentals of why investors invest remain the same. So I think if I'm a DSO owner, if I'm a founder, or if I'm somebody that is thinking about selling, be it now in the next 12 months or the next 24 months, focus on the fundamentals of running your business, because that is what an investor is ultimately going to be looking for. When you do an M&A transaction, I think things were a little rosier in 2018, 19, when you could just go out and buy a bunch of practices, consolidate their EBITDA, and go to market with that consolidated EBITDA number. And you could make a few mistakes, and given the investor interest, many were overlooking some of those mistakes. I think today, the investors are not overlooking those mistakes as much. They want to see heavily integrated practices. They want to see all of the practices using the same software system, the accounting to be absolutely perfect. They want to see culture. They want to see staff turnover being in control. So I think the fundamentals of seeing patients, collecting your revenue, and documenting it with data, that would be where I would be focusing all of my attention. And once you have that cadence well baked, be very strategic about the M&A that you're doing, right? Think about, am I buying something because it's the next shiny object, or because it adds $1 million of EBITDA to my business? Or am I buying it because it fits the strategy that we've defined as a group or as a board or as a management team? Does it fit the geography? Does it fit my subspecialty? Does it fit our culture? Those are all things that are going to set you apart from a peer group when and if the market does return, for you to jump ahead of your peers.
Interesting. If I was to summarize, and I don't mean to leave anything out, it's really run a great business, build a great business, run a great business. Ultimately, those are the assets that are going to be the most attractive on the market, regardless of what's happening, with external factors, so to speak. Is that a fair way to say it?
Absolutely right. Yeah, 100%. I mean, people still want to invest in and purchase good quality businesses. And when you compare dentistry to any other industry segment, if done right, dentistry is still a great business and it produces phenomenal results. You're doing the right thing for the patient and it can still be done. You can still do well and do good, right? And investors love that, where you are helping people and making money at the same time. So yeah, Ken, well, that's well said. I think run good businesses and those businesses will be successful at some point in a transaction if that's what they desire. Otherwise, run your business for the next 10 years and continue to do what it is you enjoy.
That's right. And if you're building a great business, ultimately it's going to be kicking off cash flow. So at a minimum, you could either be saying, all right, I'm going to reinvest this cash and try to grow in some ways, or it might be time to take some money out as well. Just as if times are lean and things are slow, and putting a little bit of money on your own personal balance sheet can sometimes give you a little more confidence to say, all right, now I want to invest a little bit more in the business and really get that going. But I think sometimes operators get a little bit, I don't know, they're just not sure what to do there in terms of, should I take money out or should I not? Should I pay dividends out and
Yeah.
all of those different kinds of things?
Well, it's been interesting. If you look at the cycle of transactions, not just in DSO, but in healthcare in general, being in a down market has forced folks to be a little more creative around achieving their life's goals, right? And each practice owner is facing different circumstances and they all have different goals. But the down market has created a challenge for you and you ultimately need to take some chips off the table, but you can't sell your business, so to speak, like you once could have. There have been creative solutions to get those achievements completed. And it's been quite interesting to watch. And you've seen it happen at the large DSO levels with dividend recaps or leveraged recaps and refinancing and restructuring their debt to create a more advanced capital stack. And that doesn't have to be done only at the large groups, right? I think if you were planning to transact today and the market is not in a way that it makes sense, you can still take some chips off the table, achieve your personal goals, and delay that M&A transaction for when the market might sound or feel better for you. Right? And that's done, as you just mentioned, Ken, with taking some distributions when it suits the business plan, or using debt appropriately can also warrant some of that. And what else has come out of this market is an enormous amount of creativity in that in-between phase, right? So you're maybe bank debt isn't the most appropriate for your structure, but you may be still a little early for private equity. There's been an entire industry built around that in-betweener, right? The BDCs, the SBICs, the direct lenders, they have really stepped up to the plate and done an amazing job for the industry in where what otherwise might be considered a liquidity desert for some DSOs. So we've seen some really creative structures get built as a result. And, bankers can always, mathematically work their way out of a situation. And so this is just another test for the bankers to see how we can put money to work for our clients.
Fascinating. One other question I wanted to ask, since I've got you, and I know that this is something that you're thinking about all the time, the concept that dental is a lower risk than other types of assets because it's extremely low default rate, which is generally measured on a one practice by one practice basis. This doesn't really have application, I don't think, to DSO, but I'm curious if there is crossover and if dental is getting any credit at this point for this, or if there have been enough defaults or other challenges or problems that have happened that perhaps the market doesn't value the sort of safety net that a dental practice might have from this perspective.
Yeah, to a certain extent, you're 100% right. I think historically, dental has been viewed as a fairly safe place to either A, invest or B, lend money. I think by and large, that still remains true when you think about practice owners being clinicians. And as a dentist or a doctor, at a single doctor practice level, most of the way that debt is structured is with a personal guarantee and various other levers that a lender will use. Whereas I think DSO, as you get to a corporate DSO, where the lenders have sort of moved up to a slightly different section of the market, there has been a lot more volatility in the debt markets and the DSO markets in the past 24 to 36 months than in all the years that I've been doing it, which is close to 20. So there have been some pretty large defaults that have occurred in DSO that I think has maybe tarnished that reputation that a dental deal is a safe deal. But compared to any other sector in the market, I think it's still better than average in terms of default rates. We are living right now through what will become the expectation for dental companies that have hit challenges, right? And there's been a couple of bank-owned DSOs where the DSO owners have turned the keys over to the lenders and the private equity firms, and they've transacted. And what's looking very positive, though, is, despite maybe some slight bloodshed, there looks to be light at the end of the tunnel with all of those DSOs that have gone through a very challenging time. And it looks, at these early stages, like they're going to pull through and transact their way out of it, which is a very good thing for the industry because it inspires confidence again that even in dark times, there's not a lot of money getting lost, and there's a path forward to bring it back to life.
All right. Well, Gareth, this has been enlightening. Definitely brought out quite a few truths about what's really happening sort of in the M&A scene, as well as just it's maybe time to bootstrap and fix up our dental practices and our DSOs, so to speak, right? Any final words for the group? Feel free to also share your contact information if anybody wants to reach out.
Yeah, sure. I would say, and thinking as a business owner, focus on your core fundamentals. Taking care of your patients, delivering quality care. Focus on the data that you can control, particularly your patient data, your systems, your financial management data. I can't stress how important it is for you to keep high quality financials. If you are planning on doing something in the markets in the next 24 months, talk to your financial advisors about switching to a more robust financial software system, switching to GAAP accounting. Those are going to be very important for investors as you think about doing a transaction. Use leverage carefully. Debt is your friend. It's the cheapest form of growth capital that you can find. But as we've learned in the past several years, there's a balance of having too much debt, and it creates a situation where you actually prohibit yourself from growing. And so, focus on the basics, work on the business as much as you do in the business. I think that's sort of where I would leave the parting thoughts. And for contact information, feel free to grab my LinkedIn. It's Gareth Petsch, Petsch, or feel free to shoot me an email at Gareth, Gareth, at phpartners.com. Ken, I really appreciate the opportunity to chat with you, and good luck to all the listeners, and hopefully we'll be chatting soon about how great the dental market had rebounded.
Awesome. Gareth, thank you so much for being a guest on the show today. It's been a pleasure. It's been a treat as always, and I always appreciate the opportunity to connect with you and your insights about what's happening in the market. To all of you listening, we're so grateful. Make sure to not miss our next episodes. We generally drop those on a weekly basis on Wednesdays, and we've got lots of great guests lined up. Again, thanks again for listening. Happy day.